Hi, and welcome to the next episode of Egg Public Voices. And today we have Anthony Doyle, Chief Investment Strategist at Pinnacle Investment Group. Anthony sends out an amazing bunch of emails that basically explains how the world is operating in today's environment, where the financial markets are performing, what's the outlook. Very catchy, straight to the point, no fluff. And this is why we have you here today, because I've got a lot of burning questions about it. Thank you for being part of Egg Public Voices. If you'd like to introduce yourself to the audience and share a bit about yourself.
Yeah, sure. As Karam mentioned, I'm the Chief Investment Strategist of Pinnacle Investment Management Group, which is an ASX-listed entity, an ASX-listed company. We're in the ASX 200. We have around about a $4 billion market capitalisation. We have a very, very simple business model. What we do is we scour the globe for exceptional investment teams, and we provide them with the working capital to enable them to start their own boutique investment management team. So we've had teams come out of, say, Fidelity, teams come out of Macquarie, teams come out of Schroders, teams come out of Royal London. They start their own business. And the important thing about that within investment management is you create a very strong level of alignment of outcomes with the investors that are invested in their product, whether it's global equities, whether it's fixed income, whether it's private market. And so essentially we're always a minority shareholder in these boutiques. We call them affiliates. And we do everything that an investment team doesn't want to do, which is compliance, HR, legal, IT, and importantly, distribution as well. And so at Pinnacle, we are constantly on the lookout for these exceptional teams that have managed money for multiple decades through multiple market cycles. And we believe that this approach is the very best way to generate excess returns for clients and their hard-earned savings. And so at Pinnacle, we have 19 boutiques, 19 affiliates across a vast range of asset classes across the globe. And I work with all of them in order to articulate their views from the ground up and the top down to their client and Pinnacle's clients, essentially. And we're very fortunate that you're one of our clients as well. And you use a range of products from our boutiques, including 5V, Coolabah Capital, Plato Global. Who am I missing? Firetrail.
That's a very good memory, Anthony. I'm impressed.
Yes. And so it's a great role in that I have access to exceptional investment teams. They're at the ground. They're, in the trenches, essentially talking to company management, talking to analysts, they're talking to Wall Street, they're talking to central bankers, and then bringing those views to Australian and global clients as well. That's really what my role is. And as part of my role as investment strategist or chief investment strategist is talk to individuals like you and talk about building portfolios for different types of market environments and different types of economic regimes and how, as I said, the end goal is to generate the returns that clients are seeking from their hard-earned investments.
Absolutely. And that is truly what I appreciate with the business model, is the ability to speak to different managers across all the asset classes, but to have the backing of Pinnacle's research, Pinnacle's support behind it. Now, in your role and across all the major asset classes that you operate in or review and research on, given the environment we live in today, how would you compare this with the GFC versus COVID versus the Euro debt crisis? How do you see the current crisis? Any similarities, differences, or anything that sets it apart?
There's some parallels and then there's some important differences. So I've been in markets 24 years now, started it in 2002, and I worked in London for 12 years, and I worked in Dublin for a couple of years as well, so I'm part of European markets. And where the parallels are is that today we operate in a heightened level of uncertainty, which is similar in terms of what we saw during the GFC, high levels of uncertainty. COVID, high levels of uncertainty. European debt crisis, high levels of uncertainty. COVID, extremely high levels of uncertainty. And today what we have is an environment of geopolitical uncertainty, interest rate uncertainty, inflation uncertainty, fiscal policy uncertainty. And
what a time to be alive.
And a transformative technology in artificial intelligence.
Yes.
And the uncertainty that brings. And so they're the parallels. When you see these types of environments where uncertainty is higher, what you see is violent price action, both to the high side and to the low side, for markets as a whole and individual securities as well. So to paint a picture for you, in COVID, very uncertain environment. And we sometimes forget, it was only 5 years ago, 6 years ago.
I do forget that.
But until there was a vaccine developed, we didn't really know when borders were going to reopen, economies were going to reopen. reopen. And in that type of environment, narratives dominated. So we were going to Zoom forever. We were never going to get back into a room because we were fearful of viruses. Peloton did extremely well because gyms were closed. Beyond Meat, we were going to stop eating protein-based meat.
Yep.
So we were looking at plant-based alternatives, for example. And Moderna, the transformative technology in mRNA vaccines, was anticipated to continue to generate higher earnings as well. All these stocks have declined between 75 and 95%. Since COVID. So when you get higher levels of uncertainty, that's when narrative can drive the price action. In the short run, the markets are a voting machine, but in the long run, they're a weighing machine. That's what Benjamin Graham said.
I love that quote.
And so in the short run, particularly today, when social media is increasingly attracting our attention, the established financial news media has to become a lot more alarmist in order to draw our attention so that they can sell advertising for their business model.
Correct.
And so the media is becoming more sensationalist in nature. Markets are increasingly fast moving. If you think about hedge fund activity, the reduction in trading friction around trading online, for example, if you're thinking about trading on margin or trading on leverage, low volatility targeting strategies, markets are increasingly fast moving and will price in headlines very, very quickly. And the market structure has changed a lot over the last 20 years. It's no longer the fundamental investor that sets the value of securities, but those short-term actors which have very different motivations. The day trader has a very different motivation to the long-run institutional endowment, for example, or family office. And so in this type of world, one of the ways that investors can approach it is to be patient. And the time arbitrage is really the arbitrage that long-run investors can exploit to their advantage. So when they see that there's forced selling going on or there's market upheaval, long-term patient capital can take the other side of that trade where the valuations are simply out of whack with the prices of securities. And so a lot of the work that I do with clients is talking about the behavioral heuristic or behavioral biases that we have as investors. And I encourage investors to invest like superannuation funds or invest like endowments or family offices with that very long run time horizon rather than trading on Donald Trump tweet or whether the Strait of Hormuz is open or not.
Oh, that will be a very hard tweet, a very hard bet to place, considering it changes every couple of hours now.
Exactly, and the market's trading on headlines. Like the price action this month, the S&P 500 is up 12%. In April. And the market is very much saying the Strait will reopen and looking through it. So trying to trade around headlines is very, very difficult.
Absolutely.
But you do see these opportunities to allocate and generate higher returns in the fullness of time by taking a more measured approach. And when we say that the market is a weighing machine, that's where fundamental analysis can thrive.
Given the backdrop and given what you just explained about the behavioral pattern of investors that we see, how do you view the rise of ETF and passive investing in the past 20 years? How has that changed the market landscape? How has that changed the broader society's approach? And how would that get impacted in the current environment? What do you see that happening?
I mean, someone told me a quote yesterday, price is what you pay, but value is what you get, right? And the passive fund industry has been extremely successful at selling a narrative that active investment managers underperform. So why pay higher fees to access an asset class when you can have passive beta at 10 basis points, 6 basis points, 5 basis points? There's products in the United States that are 0. That's been a very forceful narrative within capital markets over the last 20 years, whether it's a Vanguard or a BlackRock or a Van Eck or a Beta Shares. They've said, look, you can harvest passive beta because active managers on average underperform. And that's true, that is accurate. But what we are doing at Pinnacle is identifying the managers that deliver top quartile or top decile returns within their peer group within a particular asset class. If you can identify those managers, whether it's looking at their investment philosophy, their investment approach, the resources they have, their track record, how they've invested through time, did they change their spots when the market wasn't in their favor, sort of work that you do, for example, and that superannuation funds and institutional clients and endowments do around the world in identifying exceptional investment managers, you can generate substantially higher returns than you would receive via a passive beta exposure. Now, the danger of investing in an index replication product today is concentration risks have never been greater.
Right, yes.
So if you invest in the ASX 200 index today, around 45% of that index is the top 10 stocks. Essentially, what's your view on Australia's large four banks, Macquarie, BHP, Telstra, Goodman Group, Wesfarmers? Outside of that, the other 190 stocks, whether they're moving up or down, doesn't make much of a difference.
Yes.
So in the last financial year, the ASX 200 delivered a 10% return. 50% of that was the price action of CBA.
Right.
Essentially, concentration risk is growing for indices around the world.
Yep.
The US, the Magnificent Seven, Europe, Japan, Australia, UK, all running with concentration risk. Top 10 stocks are between 38 and 50% of indices.
58.
50. In
Wow.
Taiwan,
That's-
TSMC is 70% of the Taiwanese index.
Right.
In South Korea, Samsung and SK Hynix are around 65% of the Korean index.
Wow.
And so you're essentially just making a play on one or two stocks within those markets,
That's
right?
right, yeah.
And so we are very much of the view that active investment management can capitalize on those fixed flows that are going into passive vehicles. And in today's regime, which has rapidly shifted from the zero interest rate quantitative easing world to higher inflation, higher interest rate world, you need to take an active approach.
Yep.
You need to be forward looking.
Definitely.
Because if you're just relying on the winners of yesterday, in a world where those uncertainty elements are higher, which I mentioned earlier, interest rates, inflation, fiscal policy, geopolitical risk, and AI disruption,
Yep.
well, there are companies that won't exist in 10 years' time, but there are companies that will absolutely thrive.
Yep.
And so in the long run, there's a 98% correlation between earnings and market performance when you think 5 to
Fascinating.
7 years.
Yep.
But in the short run, it's a volatile journey. And Munger, Buffett's partner at Berkshire Hathaway, he said, if you can't stomach a 50% decline in your investment when talking about stocks, then you deserve the mediocre results you will get. And to give you a statistic, the S&P 500 since 1950, US stocks have delivered a 10% annualized return. The average retail investor, 4%. So 6% differential.
Yes.
Because retail investors are more prone to behavioural biases and they buy high and they sell low.
Yeah.
And correct me if I'm wrong, but that's not what you're meant to do.
Yeah,
You're meant to
not
try
what
and
you're meant
do
to do. Try to do the
reverse.
opposite.
Exactly.
Absolutely.
Yeah.
On that particular point, in this environment again where you got higher inflation, higher interest rate, possible higher unemployment figures coming through as well with all of the job disruptions,
Yes.
combining with behavioral economics, sounds like a perfect storm brewing. So I got two layers to this question. The first question is, are we then looking at a condition that's brewing into a GFC-like scenario? And the second question on the back of that would be, where do you see inflation, interest rates really heading based on today's scenario?
Yeah, I mean, I don't foresee a financial instability crisis at all. So GFC is the worst kind of event that we've experienced, probably worse than COVID in a way. But if you cast your minds back to 2007, 2008, policy has developed to a large extent in terms of the tools that both monetary policy and fiscal policy can deploy in a financial instability type scenario. And you sometimes forget that in 2023, until ChatGPT was released, we were still concerned about Silicon Valley Bank and Credit Suisse, for example.
Yes, yeah.
And really it's been since ChatGPT was released that we've seen this sort of bull market in equities take off. But the response from the US Federal Reserve to that financial instability caused by the collapse of Silicon Valley Bank was to expand the range of collateral that they would accept on their balance sheet, which helped to stem financial instability concerns. So I'm not forecasting a sort of GFC style of event, notwithstanding that AI will be disruptive. And we are seeing job layoffs for white collar workers who've been previously immune to industrial developments and technological shifts. But as humans, we're very good at seeing the sectors and the jobs that are replaced, but we're not great at forecasting the sectors, the businesses, the jobs that are created as a result of technology.
Correct.
And if I think about our experience at Pinnacle, we are deploying AI tools within our business. We have 2 specialists in AI, a chief AI strategist and an offsider, and we're looking to expand that team to 8.
Yeah.
So that's creating employment, for example. And so that's just one little example of what's going on. My view is the central tendency of the real economy and markets is by definition most likely to occur. And so it pays to be overweight growth assets relative to defensive assets, but the tail risks have grown.
Yeah.
The left and right tail risks because of the heightened levels of uncertainty that we're experiencing. At the moment, the risks of a stagflationary environment are growing depending upon the duration of the oil crisis.
Okay.
Now, with that in mind, what I'm talking a lot to investors about is not just simple asset class diversification, but regime diversification. So we can build into portfolios asset classes that do well in different types of environments. Whereas today, I see a lot of portfolios that were built up for a world of low interest rates, quantitative easing, inflation within target. Well, the RBA is not expecting inflation to return to 2.5% until the middle of 2027. Or middle of 2028, sorry.
Oh, right. Okay.
And so with that in mind, obviously we're now in a rate hiking cycle.
Yeah.
With the bond market expecting another 2 rate hikes at least this year from the RBA, depending upon, again, to what extent do higher energy prices feed through into actual inflation and inflation expectation. Well, we have asset classes that will benefit in an environment of rising interest rates, in that stagflationary environment. And more specifically, floating rate notes, for example, or securities or asset classes that are linked or pay a spread over and above interest rates.
Yes.
And so what I'm talking a lot to clients about today is floating rate note exposure in public credit markets, but also in private credit, private debt as well. So we have a manager called Metrics, for example, in that space.
Very interested on views around the private credit space, because that's obviously been in highlight this year post the ASIC report and also the news flow. Again, the media sensationalization around Blue Oil or Cliffwater and the likes of it coming out of the US. Where do you see the sector as a whole going in Australia and in the world right now?
So when you allocate to private markets, whether it's private equity, unlisted infrastructure, private debt, private credit, essentially the decision with who you invest with is as important as the decision to invest in the asset class itself.
Yeah, correct.
Because if I'm allocating to Australian equities, a style neutral manager, one that doesn't, a core type of manager, one that doesn't make a big allocation to a value bias or a growth bias, I know that the dispersion of returns between a top quartile manager and a bottom quartile manager will be relatively compressed. Whereas private credit, for example, as I said, is a broad church. So the dispersion of returns can be very wide. And you might have a manager in there that is mezzanine in the capital structure, that has a loan book of 13, 14 loans within the fund or within the structure that they're selling to clients, that might have 2 or 3 individuals within the team that have a very narrow sector focus. So maybe they're just financing residential property development in parts of Western Sydney or on the fringes of one of the top 5 capital cities, for example. And then on the other side, you could have a manager that is lending to the likes of Woolworths or Coles, that is very well diversified by sector, that has over 300 loans within the portfolio, that has managed private credit through multiple market cycles through a couple of decades, that has a very large team of over 475 individuals that can work very proactively to ensure that loan arrears are kept low. And then of course, being senior secured in the capital structure. So you have a claim on assets, but you're also first paid when the loan payments come in, and have again a very short duration profile of the loan book. And so I welcome the focus from ASIC on Australian private credit. It's been a very popular asset class. Our manager Metrics is the largest non-bank lender in Australia, and they've been held up as sort of best in class in terms of disclosure, because I see a lot of private credit managers that I would not go anywhere near. And so when you think about it like that, private credit for the top quality managers, I think will continue to generate excellent risk-adjusted returns for clients and are worthy of a space in a diversified portfolio of assets. And we have a number of listed vehicles on the ASX that investors can allocate to. I'd be concerned about, they're the sorts of questions that you want to ask your private credit manager. Where you sit in the capital structure, how diversified is the loan book, what's the sector allocation, what's the credit rating, etc. And when it comes to global versus Aussie, global, you're looking like the Blue Owls of the world, 20% software exposure. Aussie, next to none. It's a bit like the reflection in the Australian equity market. The US dominated by the likes of Amazon, big tech firms, Meta, Apple, for example. Whereas Australia, our tech industry is a lot smaller. So I'd be cautious on global at the moment. And actually what we're seeing from the institutional client base is Australia is seen as a safe haven in this world. Australian private credit, very much in demand, because our growth will be relatively resilient because fiscal spending is strong.
Correct.
And so I would favour Australian private credit with a well-established manager over global private credit today because of the concerns around software exposure and the impacts that AI will have on some of those software names.
Yeah, and I suppose Australia often has been the safe haven across all asset classes, general economic condition, currency as well, and we likely see that again in the backdrop that we live in, that Australia will be a favourable investment destination because of the safe haven status. Now, if you were approached by a family office or a high net worth, ultra high net worth individual today going, I've got $30 million, where would you be allocating that funds to in terms of asset classes?
I mean, portfolio construction is like a fingerprint, right? Everyone is unique and everyone is different. And so obviously working with you in order to determine an appropriate risk profile is the very first step that you can undertake. But $30 million is a sizable sum of money. I'd love to have that much money one day, but I've got 3 kids and they're eating me out of house and home, and we've got a 1-year-old puppy as well, and he's costing me in vet bills. And vet bills are up 50% since COVID, believe it or not.
Absolutely, inflation, COVID, everything.
Yes, 30 mil. So maybe one day.
One day.
I seek to obtain that one day. But if I was building it for myself personally, one of the first things I would do is think about how can I generate a level of income that's going to compensate me for my cost of living and for my lifestyle, for example. As you know, 3 young kids, I've got to buy football boots, I've got to buy shin pads, I've got to pay school fees, I've got a couple of loaves of bread a week, etc., etc., etc. So what is that base level of spending that I do? And then maybe, obviously, I want a cushion above that for holidays and lifestyle, etc., etc.
A lot more expensive holidays as well.
Exactly, yeah.
Given the airfares and you buy
global
5 tickets that you have to buy.
Correct.
And the puppy hotel, I imagine.
The puppy babysitter, she was around yesterday just meeting, our dog's called Lucky, so she was meeting Lucky, and
That's brilliant.
But obviously that's a cost as well. So what income can I generate that's relatively risk averse from asset classes to compensate me for those costs? And maybe, build in a cushion over and above that. And so I'm looking at fixed income predominantly, both public and private credit. And today what I want is relatively short duration product, which means I'm not taking much interest rate risk. So I'm not so worried about whether interest rates are rising because of inflation concerns. I'm not worried about the US continuing to expand its debt and so yields rising, because a lot of investors don't realize that actually they've been allocating to fixed income duration products like government bonds and corporate bonds. Well, I can tell you the total return on that asset class over the last 5 years, exactly 0. Inflation's up 25%, so you've gone backwards in real terms. So I want to compensate not only for my cost of living, but the rising inflation elements as well, for where I spend money month in, month out. So that would, whatever that is, it might be 20% of the 30 million, might be 15%. I want a really decent allocation to growth asset. When I talk about growth asset, Aussie equities, both large and small cap. I want a good allocation to global equities, large and small cap. I want some emerging markets in there. I want an allocation to real assets like listed infrastructure, unlisted infrastructure, maybe even global real estate as well. And then I also want, for my long run wealth accumulation, a good allocation to private markets as well. So such as private equity. And I know that you have an allocation, or you work with our boutique 5V, which is the Australian mid-market space. Ideally, if I've got 20% defensive allocation that I'm just living off the income, the 80% that might be a lot more volatile, can move up and down and fluctuate, I don't touch it. So when markets draw down, I'm not crystallizing a lot. And I just want to let that run. And you're thinking about building with a sum that large, generational wealth. That you can pass on to your kid and grandkids. And when you think about your investment time horizon, might be, if you're retired another 20, 30 years, life expectancy, well, your kids and grandkids, their life expectancy is 70, 80 years beyond that. So you just want to let the growth assets run. And so this is why, if you look at a 5-year chart of the equity index, it goes up like this. But if you look at the 50-year chart, often you have to put it on a log scale. And suddenly, the big declines don't seem so bad, because you've generated that exponential wealth through time, that linear wealth through time. And if you don't believe that equity markets are going to appreciate in value over the long run, there is an asset class for you called gold and cash, and you can go and dig a big hole in your backyard, and you can buy a couple of shotguns and some tin cans of food. And you can sit on your gold and cash, because
a lot of people doing that.
That's it. Because throughout human history, tomorrow is better than today.
Yes. that has
Rising
been the
wealth,
mindset.
declining poverty, better health outcomes, better technology, productivity gains, efficiency gains, and that's a future that I believe in. It pays in investing to be optimistic because, as I
Certainly.
said, if you went 100% to fixed income 5 years ago, you're negative 25% in real terms.
Yeah.
The equity market over that time, small caps up 110% in Australia, Aussies up 120, globals up 135.
One last question I've got. Between all of these asset classes and the sub-asset classes that we spoke about, if you have to pick a favorite, what
Yeah.
would that be? Just one.
Right now,
Right now.
my favorite trade today, given the price action that we've seen, is for quality growth stocks.
Great.
So you're looking at valuations for companies like Amazon and Microsoft and Meta. Their valuation relative to the market is as cheap as we've seen since the GFC. And these are the companies that are facilitating the developments in artificial intelligence. And I think that if you allocate to those types of companies today, we have a manager called Hyperion that have been managing those types of portfolios since 2002, then over the long run, you will benefit from that valuation discrepancy that's opened up as a result
Yeah.
of higher interest rates. So from my perspective, again, it's going to be a more volatile journey.
Yes.
Not only Hyperion, I'd also have a good look at systematic strategies
Yep.
versus passive. And so we have a manager there called Plato.
Yep.
So maybe a blend of those two where I've got a manager that's looking to hit singles rather than sixes, aims to outperform the MSCI World Index by 4% per annum. And I'd blend that with that really punchy AI exposure that's going to generate and compound wealth over the long run.
Yeah, perfect. Well, thank you very much for your time this morning. And I guess if I could summarize it, it's really the core thesis here is a diversified portfolio, something that an 80-20 split, knowing that there's a growth element, there's the income element, but really an investor should be optimistic of where the outlook would be for the world in the next decade, in the super long term, for the longevity of the funds and for the family in the future as well. So let's hope it'll be a much better year from here moving forward. And thank you very much for your time.
My pleasure.